Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, we'll have full market coverage ahead as stocks kick off the week in the green. Plus, crypto rebounds over the weekend, but what's the next catalyst to drive the asset class higher? And Apple is seeing strong demand for its new iPhone, according to new data. We'll discuss that and more on Market Catalysts. Taking a look at the major averages here and where we stand, we are seeing a little bit of a lift in today's session. The Dow right now up about 280 points, and it seems like a combination of anticipation of earnings, a lot of big reports coming this week, and perhaps a little optimism or at least lack of more negative news flow on the trade front is helping to propel stocks higher. We've got the S&P up about 0.75%, and the NASDAQ is leading gains about 1%. Now, we should mention this is not really the peak week for tech earnings, even as we see the NASDAQ advance the most of the three major averages. We will hear from stocks like Netflix, companies like Netflix this week, but most of the largest companies start to report next week. So just something to note as we look at the action today and the action over the course of the week. We continue to see really low bond yields here, sub 4%, so 3.99% is where we stand today. We will be getting that consumer price index report on Friday. Remember, it's delayed, of course, because of the government shutdown, and that could then feed into expectations for what the Fed is going to do at the end of the month. And then taking a look at some of the movers under the surface within stocks here. If you look today, it's a pretty broad-based rally. All of the groups in the S&P 500. Oh, I spoke too soon. The consumer staples just a little change, let's call it, but tech and industrials are leading the gains here today. Just a quick check as well. I was going to look at the sort of 1 month look here for the sectors, because we have started to see some rotation here as we get into the last quarter. Utilities, healthcare have really been the two groups that have done the best. So a little bit more of a defensive rotation versus what we tend to see. And then I also want to mention what's been going on with crypto. So this here is the 1 month look at crypto, and it's a much more mixed look than what we had been seeing here. But today we are seeing a bounce back in the major currencies. Right now, we've got Bitcoin higher by about 2.8%. If you look at the 5-day here, you see kind of the rockiness over the weekend and then the rally into today. And as I mentioned, crypto is climbing this morning as digital currencies attempt to recover from a sell-off that sent Bitcoin to its lowest price since June. But with institutional adoption underway, long-awaited regulatory approval too, what's the next real catalyst for crypto? Let's talk to Robbie Mitchnick, BlackRock head of digital assets, and of course the manager of iBit2, which is the biggest ETF tracking spot Bitcoin by a long shot. Robbie, it's always good to talk to you. Thanks for coming in.
Yes, Julie, good to see you.
So let's talk about some of the recent action, first of all, because we've had a lot of volatility. We had the so-called crash in Bitcoin, a mini crash in Bitcoin, but more so in a lot of the other crypto coins a couple of weeks ago. What does that tell us about kind of where we are in the crypto cycle?
Yes, well, of course, 2025 had been and still has been a fairly positive year to date. But that episode on the 10th, Friday the 10th, last week, shone a light, I think, on some of the challenging, maybe concerning dynamics in the space, and particularly with respect to the amount of leverage that's out there. If you look at the sort of offshore futures trading market, the open interest in that is less than 2% of the total value of Bitcoin, but it represents 70% or more of the trading volume. And so what you have is this tiny slice of the market that actually trades a significant majority of it with much higher frequency and in a much more speculative kind of volatile way. And that creates a lot of confusion for investors when you have these whipsaws that don't seem to make sense from a fundamental perspective.
Does it a lot of it is in the coins that are not Bitcoin, but does it have a feedback loop to Bitcoin itself also?
It does. I think over time, as you see this market mature, you're going to see a decoupling of the way Bitcoin trades from the way most of the rest of crypto trades, because Bitcoin really is in a category of its own as this sort of prospective digital gold, as a global scarce, non-sovereign emerging monetary alternative. That's very different from what the rest of crypto is, which is more of a technology bet on blockchain innovation and adoption. And there's lots of exciting things going on there, but it's important for investors to remember that the vast majority of crypto assets by number are totally worthless, right? And so there's a bunch of exciting projects there. Bitcoin clearly is an important asset. We think Ethereum, there's a handful of others, but investors have to be really careful trading sort of the long tail of assets, particularly trading them with leverage. And you saw that in the flash crash of last Friday. A lot of investors got burned.
Robbie, this is a really interesting point, but I think that there are still a substantial number of people buying these coins who see it as a lottery ticket, right? Because Bitcoin is over $100,000 now. The people who made the lottery already did it, right? Most, I mean, unless you think it's going to $1 million, which definitely there are people out there who do, but nonetheless, it's a tougher lottery ticket. All of these small coins, sure they may go to zero, but they could go to the moon, right? And so that's sort of the promise for some individual investors for this kind of thing. If they know that that's the risk they're taking, does that make sense to you as a reason to get into some of those?
Well, I think it is concerning. And if you think about the magnitude of leverage that's being used here on some of these offshore levered futures platforms, it could be 100x leverage, right? I don't think anybody should be trading Dogecoin 100x levered, right? And so when you saw that flash crash of last Friday, 19 billion in liquidations. It's an extraordinary number. And we're talking about liquidations, you're auto-liquidated, your position value goes to zero, right? And so every time that happens, a lot of people get hurt, it adds volatility to the market, and so it's one of the things that confounds some of the more long-term, patient, institutional type investors because they look at a price reaction, say in Bitcoin, to a small piece of economic or political news that has very loose connection to it, if any, and see a relatively strong short-term move, and it causes them to scratch their head. Okay, how do I think about this in a portfolio? How do I think about trading behavior and correlation? Now, the good news is, at least in something like Bitcoin, over any medium or long-term horizon, it tends to shake that off. Like I said, less than 2% of all the Bitcoin held is represented in those futures contracts, even though they make up such a significant percentage of short-term trading volume. So over time, the more sophisticated sort of long-term buy and hold type investing activity takes over and predominates, but not with that short-term noise.
When you talk about leverage, I got to ask you about crypto treasuries too, because not only are we seeing more and more companies put Bitcoin and other crypto on their balance sheets, many of them are using leverage of one kind or another, whether it's levering up their balance sheet to do it or some of the other strategies. Is that also a point of concern?
Well, obviously there's been a lot of interest over the summer in this new digital asset treasury construct. That interest seems to be fading a little bit in some pockets. So you've seen some of these multiples to NAV that were very high come, and meaningfully retreat. So we'll see what happens there, because of course a lot of the business model is reliant on being able to trade at a premium to the net asset value, and if that no longer is the case, it's difficult to keep growing. So we'll see how that plays out.
I mean, do you think that is a good thing or a bad thing for the ecosystem? I keep thinking about Long Island. Was it Long Island iced tea? The
original
in the last cycle where everybody was like slapping crypto names on their companies, even though they had nothing to do with it. Now you see companies that have nothing to do with crypto buying it on their balance sheets.
Yeah, well, I think that it's not having a ton of impact on the market anymore. Sort of the peak of that activity was certainly over the summer, and it's faded, but it goes back to that point. Blockchain's exciting, digital assets are exciting, crypto's exciting, but people have to remember the vast majority of crypto assets by number will be worthless, right? And so people have to be very careful and discerning in terms of where they're placing their bets, how they're trading, and certainly when it comes to using leverage.
So something else I want to ask you about is, this has been a big year for crypto, obviously. A lot of that has been driven by DC and the sort of sea change in regulatory attitude. That has driven at least some of the price action. So what now, in terms of, if that's been one of the big catalysts, is there another big catalyst that people should be watching for?
Right. Well, that process is only partway played out, right? So in July, the Genius Act was signed. That was the first priority to get stablecoin regulatory clarity. And I think that was a terrific milestone for the industry. And we certainly are very excited about the opportunity for stablecoins in all kinds of applications, going beyond where they're used today, which is primarily in the crypto trading and DeFi ecosystem, but actually to be adopted in cross-border payments, both retail and corporate multinational, to be adopted potentially in financial market transactions, settlement, collateral, et cetera. So that's exciting, and that's now on its way. The second key piece is the Clarity Act, which is about crypto market structure. And that is still something that is sort of brewing in the legislative process, and we'll see what course that takes. In the meantime, there's lots of sort of rulemaking going on at these regulatory agencies to try to start to put frameworks around this space. It's a lot harder than it sounds, right? And so there's a lot of complex issues and questions that arise with this technology in ways that we hadn't seen before in traditional securities markets, because it's 24/7, digital, global, interoperable, all those things. And so that's going to play out, frankly, over multiple years.
But you're pretty confident it's going to get done.
There's a lot of positive momentum, and it's become, frankly, a lot of bipartisan support too.
Robbie, good to see you. Thanks
Great
so much
to see
for
you.
coming in. Appreciate it. Coming up, investing in infrastructure amid the AI data center boom. We'll be right back. Private investments in infrastructure have exploded in the past 20 years, growing to $1.5 trillion in 2024. And according to analysis from Goldman Sachs, the market could grow to $2 trillion by 2030. Let's bring in Philippe Camus. He is Goldman Sachs chairman of infrastructure at Goldman Sachs Alternatives. And this is ahead of a big alternative summit that you all are having tomorrow. So thank you so much for being here. So infrastructure spending in the last year or two has become sort of shorthand for data centers. But we're talking about the whole thing. And when you look at what's going to drive that spending through 2030, is it going to be mostly the data center and that ecosystem? Or what are we talking about here, where that growth is coming from?
Well, it's interesting because data centers, it's right, when you talk about infrastructure, hijacks a lot of the attention. But infrastructure is really not static. You know, we've been investing in this asset class for 20 years. And when we started, people thought infrastructure was all about roads and ports and airports and regulated utilities, and that was it. And there was no digital infrastructure did not exist, renewable energy did not exist. And then you fast forward to today, and when you talk about infrastructure, you think of digital, and then you think of data centers. The truth is, infrastructure is really firing from every single cylinder that it represents today. You think of transport, the capital required to upgrade all of our stock of, ports, roads, airports is massive. You think of energy, all of the investments for the energy transition, massive. Digital, you talked about it. Data centers, all of the energy to power the data centers. It's a huge demand for capital. And I think we are today at a point when the supply of capital is greater than it's ever been. So infrastructure as an asset class has really grown to $1.5 trillion today, coming from 50 trillion when we started. But the demand for that capital is also massive. And again, energy is a big part of it, but it's really, the demand is there for every single subsectors we invest in.
So there's a lot of demand, there's a lot of capital. It is private investment, but infrastructure as an asset class is perhaps unique in that it also needs that public component, whether it's policy, whether it's co-investment, whether it's regulation. So where are we on that front?
So one way to think about this is when you invest in infrastructure, a little bit like real estate, you have a concept of core infrastructure. Think of it as your roads and your airports and your electricity and your gas. But then you have a core plus and a value add, where you move up the risk spectrum. If you think of core, you do need government subsidies. You do need government contracts. But as you move up the risk spectrum and you go to value add, that need for subsidies, for contracts is much less important. And so there will be lots of different places that will require government help, some that will not. We tend, as an investor, to focus on value add, where we don't need government help. We like to go where we know that what we invest in works on its own, on a standalone basis, without subsidies, if you want.
So where are some of the most exciting opportunities you're seeing now in that value add piece?
So really, we see a lot of exciting opportunities. I think waste The circular economy is a huge part of what we are focused on. When I think of waste, I think of all the biosolid, the municipal waste, but also managing that waste that used to be dumped, that now is not dumped anymore, is really kind of recycled as much as possible. Waste to energy. Waste to energy is really exciting because you both manage the waste, you recycle the waste, but you transform that waste. You reuse it. And so we do pre-consumer waste to energy here in the US, treating the waste from big corporations, people that handle the waste, transforming into biomethane gas. In Europe, we do agricultural waste to biomethane. So taking the farmers' waste and putting it into the grid. There's a huge demand for that because it's green gas, it's recycled gas, and it sells for a significant premium to where the spot price for gas is. And so that's the kind of stuff that we are really excited by. We are also big investors in the circular economy, doing what we do better. So for example, we provide modular units for education, for daycare, for construction sites, big infrastructure. So these are model units that are in timber, wood. So they recycle, you can move them. So that's the kind of stuff that, which is not that obvious, where we see really exciting opportunities, strong tailwinds, long-term contracts, good counterparties, very good unit economics. That's the kind of stuff we like.
And is most of that privately held that you are investing in, or is some of this work being done by publicly traded companies as well?
The things I've mentioned are typically privately held. Again, you can invest. I'd come back to the more core side of the spectrum. If you invest in roads or in airports, typically there will be concessions. You will have a leasehold that you will be, or a port, that you will be able to use the asset for 20, 25, 30 years, but at some point, you'll have to re-bid for the concession, whereas what we buy, we tend to own.
Philippe, thank you so much. Really interesting, fascinating stuff.
Good to be with you.
Appreciate it. Apple's iPhone 17 series has outsold the 16 series by 14% in its first 10 days of availability in the US and China. That's according to research by Counterpoint. Plus, Evercore has added Apple to its outperform list, tactical outperform. Joining me now, Ramon Llamas, IDC Research Director, Mobile Devices and AR, VR. Ramon, thank you for being here. What are you guys seeing in your numbers in terms of this latest iPhone replacement cycle and how attractive this new one is?
It's really an interesting position that Apple's in right now because it's a different product portfolio and they're looking to capture a lot more different segments. I mean, we didn't have the 16E like we did last year, and that's your low cost value model. You have this interesting one with the Air, which is a brand new kind of a form factor, and so you're attracting some of those technology enthusiasts and those who are curious. And then you have your power users who are going to gravitate towards the traditional flagship and the Pro. So I think to see a number of results that are kind of bucking what we saw last year, it's to be expected mainly because it's a different kind of product portfolio than we saw from a year ago.
And what's the main differentiator for this cycle? I mean, you mentioned some of the individual kind of products, but is there an overarching thing that's making it particularly different?
I think the biggest thing that I'm seeing right now is that, Apple, and like many other smartphone vendors right now, they're really tapping into that, this very strong replacement cycle. I mean, according to our research that we see, it's been about, 3 to 3.5 years, somewhere in that, time frame that a lot of consumers upgrade their smartphones. And if we dial the clock back to, 2022, 21 and 23, that kind of time frame, that was a good high water mark for Apple and many other smartphone vendors. So for Apple to come out swinging, in this most recent cycle with a new, entry level or value phone and some new, technology pieces with the Air and staying true to its flagship and its Pro brand, there's a lot for Apple to capitalize on over there. And plus, let's not forget, the Apple loyalist is among the most eager and dedicated of fans out there. You're going to be, hard-pressed to try to wrestle that iPhone out of their hands.
Yeah, I guess so. Although it's interesting to think that, part of it just has to do with the age of the phone that they have versus the, the amazingness of the new one. So I think that's an important note. Switching gears a little bit, we noticed an interesting trend here that it's hard to miss iPhone users who are listening to music or podcasts with wireless AirPods, but there's a lot of people still hang on to their wires. According to a DataBridge market research report, wired headphones are making a comeback. The global market's actually expected to grow significantly around 20%, which would be faster than wireless from 2025 to 2032. And I'm curious if that meshes with what you have been seeing. I have to admit, Ramon, my AirPods stopped working, so now I do the wired ones. I just haven't gotten around to getting new ones yet.
And I think that's one of the great allures of the wired headphones, because guess what? 10 times out of 10, they're reliable. They're going to work. You know that as soon as you plug them into your phone or your iPad or anything else, they're going to work. Okay. And whereas if you're going to have your AirPods or some of the other, we call those truly wireless stereo headsets, just two little devices that you put on either ear over here, many things can happen with those. Okay, first of all, being not having enough of a battery charge. So there's something to be said of the neat technological advances we've had with those TWS type smartphones, earbuds over here. But you weigh that against the reliability of the wired. Which one do you want to have? And I think that's going to change from one consumer to the next. So I don't think that the advent of the truly wireless headset necessarily meant the end of the wired headphones. It only meant that there's just going to be a different kind of consumer, a different kind of use case, and a different kind of need, quite frankly, compared to what we've seen with the truly wireless headsets.
Yeah, that makes sense, and it explains why I keep using mine as well. Ramon,
Me too.
Good to see you. Thanks a lot for joining us.
Thank you.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Lululemon, Snowflake, and Darden this morning. First up, Lululemon stock, well, it's moving higher after BNP Paribas upgraded its stock rating to neutral from underperform. The firm said its current valuation is, quote, pricing in a lot of bad news, but the negative catalysts from here are less clear. The stock is already down more than 50% year to date. Meanwhile, American Express announced its Platinum Card members will get a $75 credit to Lululemon each quarter. The analyst thinks that could drive foot traffic. Next up, Snowflake stock. Wedbush raised its price target on the stock to $270. That was up from $250. The analyst, Dan Ives, said he believes the company still has ample room to accelerate growth and is well positioned to capitalize on elevated demand for AI use cases over the next 12 to 18 months. Last up, Olive Garden's parent company, Darden Restaurants. Well, it got a boost of confidence from Goldman Sachs this morning. The analyst upgraded the stock to buy from neutral. The analyst said the company improved its value proposition in casual dining. It also has less exposure to lower income consumers who we know have been pulling back and are under pressure. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Cleveland-Cliffs, the Cooper Companies, and Replimune. First up is Cleveland-Cliffs. The company said it's exploring its sites for rare earth materials. The U.S. steelmaker announced that news in its latest earnings report. Cleveland-Cliffs said 2 of its sites, one in Michigan, another in Minnesota, show key indicators of rare earth mineralization. Rare earths have become a flashpoint in the trade war between the U.S. and China. The Trump administration is on the hunt for alternative suppliers and its move to expand domestic production. Cleveland-Cliffs CEO said American manufacturing should not rely on China or any foreign nation for essential minerals, and Cleveland-Cliffs intends to be part of the solution. Next up, the Cooper Companies. Shares are rising after the Wall Street Journal reported activist investor Jana Partners has built a stake in the medical device company. The investor plans to push for strategic alternatives, according to the Journal. That could include a potential deal to combine its contact lens unit with rival Bausch & Lomb. The idea already has the rival's support, with its CEO saying in an interview that he would be interested in such a combination. And finally, Replimune. Those shares are surging after U.S. regulators accepted its resubmitted application for a skin cancer for treatment. Its initial application was denied in July. The FDA cited issues with the company's trial design and patient population. Replimune's drug was being closely watched by biotech investors who have worried that new leadership at the FDA was taking a harder line on drug approvals. The FDA is now expected to make a decision on the drug by April 10th. That's according to a company statement. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We have much more market action coming up. Stay tuned. You're watching Market Catalysts.
Again, there's so many nuances within this market, and even just today, all the whipsaw that we've seen with these headlines. I guess, what do you make of what we saw earlier, the sell-off with the regionals, private credit stress, and then recovering a bit off of those more optimistic comments from President Trump?
What I think is interesting about what's happened with the regional banks and these recent mishaps is it further highlights the bifurcations that exist more broadly in the economy. So when you think about the fact that the Zion's news, the Western Alliance news came right as we were getting reports from the larger banks in the beginning of earnings season. And given that the larger banks, their borrowers tend to be much higher in quality, higher in income. So you see these bifurcations, and it reflects kind of the K-shaped nature of the economy. You see it in inflation data, you see it in consumption data, and it has translated into market behavior too. There's just sort of the group of haves and the group of have-nots.
Right, the bifurcation of the consumer and then the bifurcation within the actual stock market. And we'll talk about tech in just a second. But when you look at what's going on with the regionals, and to borrow Jamie Dimon's quote, a few cockroaches means there likely are more. How do you separate what's idiosyncratic or more systemic by nature? Are there certain clues or signals that you look at that would maybe spook you a bit more?
Well, to measure whether it's spreading sort of up the size spectrum, listen to the larger companies. Analysts undoubtedly will be peppering the companies they cover with a lot of these questions. Look at broad measures of credit spreads, which have not blown out. So I think there are metrics to watch filtering into the equity market, continued move higher in the volatility index. But I think that we're probably in a somewhat similar situation to the early part of 2023 when we had the mini banking crisis. And you did have a period where it was an infection more broadly in the market and in the larger financials, but ultimately things settled down, and in fact it triggered some consolidation. And it wouldn't surprise me to see some of that consolidation.
So shades of the SVB collapse, potentially?
Hopefully nowhere near as serious, but it reflects the lower sort of quality nature of many of the borrowers down into the regional banks, and the fact that we're somewhat late in the lending cycle and you're starting to maybe get a sense of a little bit less proper due diligence, which is, I think, part of this story. And I think it sort of puts the larger financials in a position to really make sure that due diligence is up to snuff.
Yeah, interesting. And I'm sure the Fed, which meets next week, they'll probably get some questions about this as well, potentially.
No question.
And when we look across the stock market, I mentioned tech. And we've been hearing, is this a bubble? Are we priced to perfection? We've seen this circular investment cycle among all the major banks. Where do you sit with tech right now? Are you optimistic?
So if we think about AI-specific tech, so let's use the Magnificent Seven instead of just picking on tech, because it's a pretty diverse sector. The one thing, it's not an imminent concern, but maybe something that bears watching. So Mag 7 as a share of overall S&P 500 CapEx is about a third. So that's a pretty high percentage of CapEx driven by just a small handful of companies. Free cash flow growth for the Mag 7 has gone from more than 60% positive 5 quarters ago now into slight negative territory. This boom, I think the word bubble tends to get thrown around too much. This boom has been largely an equity financed boom. It's come out of cash flows. Now that free cash flow growth has decelerated into slight negative territory, and you're starting to see more deals that get done with debt. It's just kind of a back of mind thing to focus on. The maybe good news is there's less speculative fervor in those mega cap dominant names. The recent kind of hype cycle has gone into more esoteric, micro, small levels, like at the basket level, quantum and drones and the meme stocks. And those have come off the boil a little bit in the last several trading days. But that's where speculation that is very AI driven is now more concentrated in these kind of tiny little pockets, as opposed to in the mega cap names that had been all the rage in the last couple of years.
And that's super interesting to me because people have told me that this is why this is different than the dot-com boom, because you have companies with really strong cash flows and balance sheets. And you were just talking about how we're seeing more of this debt financing. I guess at what point do you think we're going to start to see more of that? Is that only certain companies that are financing with debt?
Those that have seen a decline in their free cash flow yields, that they can't finance it out of cash flows. I would say one of the keys here is there's a decelerating rate of earnings growth, but to your point, there's more there than was the case in the late 1990s. They're really, the high flyers actually had no denominator in the PE equation. So it was purely a price bubble. I think what we need to be more mindful of now is the earnings side, and a point where maybe the expectations bar has gotten set a bit too high. And you could have one or two high profile misses, even if in level terms, the growth rates are still strong. It's, I've been doing this for almost 40 years, and one of my favorite things to say about the market, and as it relates to things like trends in earnings or trends in economic data, better or worse tends to matter more than good or bad. Okay. It's human nature for us to think that's still a really strong growth rate, but if it's a decelerating pace, that's something to be mindful. In the meantime, you've got an accelerating pace of earnings in an index like the Russell 2000. I would say avoid the lower quality, no earnings part of that index, however.
Right, and as we get into the thick of earnings season, that's going to be critical. And real quickly here, given the losses that we're seeing today, if you step back, is this a time to buy the dip? Do you maybe want to get a little bit more defensive heading into your end?
Depends on who the investor is. I think all or nothing or get out, picking a moment in time, that's not investing. That's just gambling on moments in time. Investing should be a disciplined process over time. So dollar cost averaging tends to be a great discipline. So is rebalancing. Rebalancing is a great discipline because you're adding to where there's been underperformance, but you're also trimming in areas where there's been outperformance. It's not discussed all that much. Maybe it's a boring topic on FinTV.
Yeah, no, I love it. Let's talk rebalancing.
Rebalancing is a great discipline.
All right, awesome. Well, Liz Ann Saunders, thank you so much for coming in. What a day, and especially in studio. Appreciate it.
Talk to me about this latest deal agreement that you have with this Swiss company. And I know it's part of sort of a bigger push into quantum in Europe, but talk to me about how this fits into that.
Sure. So I'm actually talking to you from the Digital Innovation Forum in Lake Como, Italy, where earlier this week we signed a memorandum of understanding to become a founding member of a new entity called Q Alliance. And its mission is to bring quantum computing to Italy. Now, the agreement that we signed yesterday with Swiss Quantum Technology is all about placing a D-Wave quantum computer, an Advantage 2 quantum computer, our latest generation system, here in this region. Swiss Quantum Technology is paying 10 million euros to purchase half the capacity of the system over a 5-year period, and that will become accessible through our Leap cloud service to academic institutions, businesses, government entities here in Italy to drive quantum application development and usage.
And then talk to me about where we are in terms of the commercial applications. You and I have talked before. You've talked about some companies that use this for sort of business optimization. Where are we on that adoption curve and how it's making its way into commercial enterprise?
Well, we continue to drive work with our customers around first proofs of concept to help them build applications and then benchmark those to determine how much value they can create and whether or not there's a good ROI, and then working with them to move those applications into production. We have a number of customers that have now moved applications into production. I've talked about some of these in the past, like Pattison Food Group. I've talked about Ford Otosan. I've talked about NTT Docomo. We've just completed some work with North Wales Police in the UK to optimize forward placement of police vehicles and other support vehicles to be able to respond to incidents in a more timely fashion. We've done work with Japan Tobacco around molecular discovery for new drugs. So we continue to work with customers to help them build applications, to benchmark those applications, and once they determine there's a good ROI, to move them into production.
We were just showing your stock chart, Alan, and you're very familiar with it. The stock is up almost 400% this year. We've seen so much enthusiasm for quantum companies and quantum stocks like yours. We've talked a little bit about this before, and I'm wondering, are you doing anything sort of specifically and directly to court retail investors or to communicate and engage with them?
So we are working on a regular basis to help the market and the investors understand what we are doing from a technology and product perspective and the value that it can deliver into the marketplace. So over the course of this year, we've delivered our 6th generation quantum computer, our Advantage 2 quantum computer, the largest and most powerful quantum computer in the world. We've continued to move customers into production. We have demonstrated quantum supremacy on our system, the ability to solve an important real world problem that cannot be solved classically. We've increased cash on the balance sheet so that we have significant liquidity now with over $800 million in the bank. And we continue to work to communicate all those important elements of how we're building and strengthening the businesses to all investors.
So that obviously is the fundamental case. And then sometimes you get the fundamental case a little bit divorced from what people are hoping for, right? Which is, in some cases, people, it's like they're investing in a lottery ticket, right? I'm curious, you guys have obviously seen big revenue growth as you've been signing these new contracts. Do you expect at some point to see sort of this critical mass explosive growth as you gain more and more traction and adoption of the technology?
So the short answer to the question is yes. We have had a good year. In the first half of the year, we had roughly 290% year-over-year revenue growth, roughly 400% year-over-year growth in gross profit. We are continuing to add new customers. We're continuing to grow both our quantum compute as a service business, which is what customers use to run applications, as well as our system sales business, putting systems on premises. For example, we sold a system to the Jülich Supercomputing Center. We just announced the placement of a system here in the Lake Como region. We signed a memorandum of understanding for acquisition of a system in Korea. So we're driving both the application support portion of our business, quantum compute as a service, as well as system sales. And I do believe there are a few applications that will really drive what you call explosive growth. Two that I've mentioned before are blockchain and AI. In both of those areas, our quantum computers are able to support the underlying core computation much faster and with much less energy consumption. And I think that's going to be a real game changer across those two environments. For example, if Bitcoin mining today was being done on a new quantum proof of work that we developed on our quantum computer, we would be consuming 1,000 times less electricity than what's being consumed today to do mining. And we're in the process of working to bring that to AI as well.
And Alan, the other thing I wanted to catch up with you about is sort of regulation, but also initiative. In other words, the last time we talked about the U.S. approach to quantum versus, say, the Chinese approach to quantum from a government perspective in investing in the industry. Where are we at this point? And and if you could address Washington directly, what would you say that you want them to do on this front?
I think the quantum industry is still waiting to see what the U.S. government is actually going to end up doing in this arena. We've talked about this before. The National Quantum Initiative, that's the premier funding mechanism for quantum in the U.S. that was originally authorized in Trump's first administration, still has not yet been renewed. And so, we are essentially waiting for the government to get its act together and move forward with support for the quantum industry. In addition, I think it's really important for the US government to start expanding how it thinks about quantum, because up until now, what it has done has been primarily focused on long-term research for just one architectural approach to quantum. As a result, it is missing other approaches to quantum, like annealing, which is something that we at D-Wave have brought to the market. And it's also missing a focus on near-term applications. Again, like what we are doing today with a broad array of customers, and what we could do to help the US government as well benefit from quantum today, not many years in the future.
Alan, good to see you. Thanks for joining us.
Thank you, Julie.
90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. We are seeing the major averages rally here today, being led by the Nasdaq, which is up 1.4%, the S&P up a little more than 1%, the Dow higher by 420 points right now. By one estimate, monthly electricity bills have risen as much as 267% compared to 5 years ago in areas located near significant data center activity. That's according to Bloomberg. And as more data centers are expected to come online, investors are looking for ways to play the utility sector. Joining me now, Paul Zimbardo, Jefferies Managing Director of U.S. Power, Utilities, and Clean Energy Research. Paul, it's good to see you. These electricity price increases have gotten a lot of attention lately. But let's sort of take a step back and talk about the backdrop here and how much electricity demand has grown and how much of that is accounted for by the build out of data centers.
Absolutely. No, thank you for having me on. So, and to set the stage a little bit, the U.S. really has not had much electrical demand growth for the past 20 years. And fundamentally, not much has changed in the U.S. economy, maybe a little bit of reshoring besides data centers. So the data centers, by some estimates, are causing over 90% of the increase in the demand growth. We project roughly 2.5% compound annual demand growth in the U.S., and over 70% of that is from data centers. So the data center is a little bit long dated, but you are starting to see that, unfortunately, in customer bills today.
And has there been any pushback in terms of the effect this is having on electricity price? I mean, we've seen in some areas that residents have pushed back against data center construction, but is that sort of a meaningful trend as of yet?
Absolutely. And we really think it will intensify next year. So in New Jersey, they have a gubernatorial election this year coming up in a few weeks. It is one of the main topics. Both Republican and the Democrat have proposals there. And next year, there's roughly 35 gubernatorial elections. And in some of these states, it's going to be one of the big topics because you do have it increasing customer bills to varying degrees, for sure.
Is that then, for many of these utility stocks that have done very, very well, it's the best performing group of this quarter thus far, so the month to date. Is that a risk that investors now need to consider, that they, the demand that we have seen and the projections that we have seen, that they might have to be rolled back a little bit if there is significant resistance?
Yes, no, for a subset of companies, it absolutely is a risk that should be top of mind. And even more broadly, the utilities, including the power companies, are actually the best performing subsector year to date, including the independent power producers. So you do have some utilities where kind of more price takers, I call them, where you can't build the generation, versus the companies that are integrated. You can actually build the generation and you have that ability to bring the new supply. And if the data centers pay their fair share or more than their fair share, you can see more of a muted impact. So you really are seeing a bifurcation within the industry.
And so you would want you're more interested in investing in the integrated providers?
Yes, absolutely. So one of those companies is Entergy. in the Gulf Coast. They're building data centers hand in hand for Google, Meta, Amazon, and they're being good corporate citizens. They're paying more than their fair share, so the impact on remaining customers is quite manageable.
Do you think that because of this pushback, that then is going to influence the agreements going forward for the hyperscalers out there, as if they are signing more so-called front-of-the-meter agreements, that they will be subsidizing the electricity so that individual residents aren't going to have to pay big increases?
Absolutely, you described it well. Or kind of make it even more transparent. The agreements are very expensive for the hyperscalers, but this concept of behind the meter, where it's very clear that you have a contract with a new piece of generating equipment. So you build a new power plant, so there's really no concerns about cross-subsidization there. Like, that seems to be the way the world is going to in 2026.
So you mentioned Entergy. As I know you don't cover some of the smaller, more experimental nuclear companies, but I do want to bring that into the conversation because some of those stocks, they are volatile, but some of them have done very, very well. We know the administration would like to see new nuclear as well. But you have some of these established companies like an Entergy or Constellation, for example, that have nuclear generation now. They're planning to bring some more nuclear generation online in some cases. And then you have the experimental guys. So how do you think about the sort of the investing case and trajectory for some of these companies?
Sure, no, happy to. So new nuclear will play a role in the future, absolutely. It just longer term. So these hyperscalers, they want power tomorrow. They want power as fast as they can get it. And unfortunately, new nuclear, aside from it being expensive, that's not a deal breaker. It's just very long term. So there's only one company, to my knowledge, that actually has NRC approval today, and the permitting is getting streamlined under President Trump. But the new nuclear projects are really 2030 plus. So it'll be part of the mix, but that's not what the hyperscalers are looking for immediately.
And so how do you think when we talk about generation, where we should look for power generation, the industry has sort of been pushing more for like an all of the above approach. Is that what economically makes most sense right now? Like sort of getting generation however you can?
Yes, and quite frankly, the hyperscalers, there's data points. They're paying multiples of what kind of the market cost is if you can get that power in the next 12 to 18 months. So there's a company, Williams, that's working with Meta. We think they're paying over $150 a megawatt hour versus kind of grid power, maybe $50. But that's because it's behind the meter, none of that cross-subsidization concern, and you get it very quickly. So if you have that offering, really it's classic supply demand. The pricing power is exponential. It's very inelastic. As you go out in time, that pricing power does decay. So there's certainly merits for that all of the above. Storage and solar can be deployed quickly versus new natural gas from the GE Vernovas of the like take a lot of time. So that's a later 2020s as well.
So you mentioned Entergy as being one of your top picks. Are there others that you think investors really have to look at here?
Yes, another one would be PPL. So that's the Kentucky core utility where you're seeing what's nice is it's not just data centers. So to the extent there's little ripples in the data center economy, you have actual reshoring, U.S. manufacturing as well there. Their Pennsylvania jurisdiction is one of the fastest growing parts of the U.S. Mid-Atlantic, admittedly from data centers, but it offers some of those defensive and offensive characteristics as well.
Paul, thanks so much. Interesting stuff.
Thank you for having me.
Thanks. Much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Jamie Dimon saying, quote, "When you see one cockroach, there are probably more." I want to bring in Mark Zandi, Moody's Analytics chief economist. Mark, great day to have you. I just want to get your reaction to what we saw over the past 24 hours. It seems like contagion is not there. It's relatively contained. But are you concerned that this could trickle through into the broader economy? And do you see any resemblance to what we saw in 2023 with SVB?
No, Ali, not yet. I don't sense any kind of systemic problem in the banking system among the regional banks. I mean, the fundamental business appears to be good. Loan growth is kind of mid-single digit. That's kind of right where you'd want to see it. Credit quality broadly is good. Yeah, there's some pockets of weakness in consumer finance, auto, subprime auto would be a good case in point. But broadly, credit quality's delinquency rates are good. The net interest margins are improving. That goes to the Fed's easing of monetary policy. Short-term rates are coming down relative to long-term rates at which banks lend against. So you kind of add it all up. And of course, the banking system feels well capitalized to me. Underwriting has been tighter since the 2023 banking crisis, and that's all good. So no, I don't sense anything untoward here, at least in a broad sense. I'm sure there's, other idiosyncratic problems that will come to the fore, but they always come to the fore. So no, not at this point. No, I'm not overly concerned about it.
So more idiosyncratic in nature, not necessarily systemic. I guess
Right.
with the Fed expected to meet next week, I'm sure Jerome Powell is going to be asked about this. Do you think there needs to be more oversight for some of these banks?
I think they get plenty of oversight. I mean, mistakes are made, obviously. I mean, the 2023 banking crisis was a mistake, a regulatory mistake. Didn't catch the problems that were evident as SVB and some of the other banking institutions that got caught up in that crisis. So yeah, mistakes are made, but I don't sense that the regulatory oversight is lacking in any meaningful way. Something could pop up here that I'm just not expecting, and there are things to watch, no doubt about it. I mean, I heard you mentioned private credit. That's something that needs to be carefully considered. It's a much more opaque market. It's not transparent. Don't have as much information as we do for the banking system, so we need to watch it. It's been growing obviously very quickly. So there are some things to keep an eye on and to watch, but from my perch, I don't see any kind of regulatory failure here or any lacking of regulatory oversight, at least not at this point.
And beyond the banks, one of the reasons why we're seeing a lift in the overall market today is because trade is back in the headlines and President Trump speaking more optimistically about those negotiations with China. And you recently wrote that last week's $2 trillion sell-off was a reminder of how vulnerable these juiced up markets are today. When you look at the trade landscape, I guess how much of a swing factor is that when we look at the overall economy, considering it seems like tariffs, they haven't really filtered through into consumer prices in the way that we maybe initially feared?
Yeah, so I'm more sanguine about the banking system. I'm less sanguine about financial markets. I mean, valuations are high, and you can see it in the equity market, you can see it in the corporate bond market, obviously the crypto markets, commodity markets, gold prices. Everything feels a bit juiced, overvalued, bordering on frothy. And a lot of that's, it's not, the tariffs aren't the issue there. It's more just a run up related to artificial intelligence and the euphoria over that. And it's not like these aren't real companies they're juggernauts, but it just feels like investors have discounted all of that and then some. And when that happens, the markets are prone to correction. And because the surge in stock prices is so key to the well-to-do who are driving consumer spending. They're focused on their stock portfolios. One reason why the economy is holding up as well as it is in the face of those tariffs is all the consumer spending related to the surge in stock values and the wealth effects. Mm-hmm. If that gets turned into reverse and we see stock prices decline, then that's the real threat to the economy in my mind.
Yeah, and what happens if those stock gains unwind? I guess where would we start to see that first?
Well, I think consumers would respond. I mean, the well-to-do. I mean, here's a stat that I think is very telling. The folks in the top 10% of the income distribution account for 50%, almost 50%. This is my calculation. 50% of the spending, the consumer spending. So they drive the train, the economic train, and those folks, they're focused on their stock portfolios. That's where the stock ownership is concentrated. And so if stock, and right now they're feeling great, the valuation of all stocks outstanding is up $9 trillion over the past year, almost exclusively in those AI stocks. But if that goes into reverse and people see red on the screen, not green on the screen, and their nest eggs are diminishing, not getting bigger, then I think they pull back and the economy's got a problem. So that in my mind, of all these risks that are out there that we're thinking about, the what's going on in the banking system, the government shutdown and everything else, that's the one risk that kind of is at the top of my list of worries.
Yeah, and when I think of the consumer, I think of the housing market. And some folks have told me if you just look exclusively at the housing market, that is signaling some sort of a recession. So how do you square what we're seeing with housing and then the overall resilience of the economy and the stock market too?
Well, Ali, it's like we got this pitched battle going on between these two very significant broad forces. One is the kind of deglobalization that's going on. That goes to the tariffs, that goes to the immigration policy. That's a powerful headwind to the economy, and that's why recession risks are as high as they are. And on the other side, the tailwind is AI, and we just talked about it in the context of stock prices and consumer spending, but also it's also evident in investment spending, data centers, and electric power, and all that kind of things. So those two things are battling each other out, and kind of housing's caught in between. And you're right, when housing goes south, particularly in terms of construction, that historically has been a tell that the economy's headed to a recession. And right now, that's saying, hey, we got a problem. The economy is very vulnerable. Building permits are down. Construction is headed lower. So in that battle, which way this goes right now, the building permits, the housing numbers would suggest that, it suggests the economy is going to be soft here, maybe even potentially a recession. That in the battle between the headwinds and the tailwinds.
And finally, the Fed does meet next week. We were just talking about all of the uncertainties that are around this economy at the current moment. And we heard from several Fed officials this week, and it seems like a December cut may not necessarily be a done deal. When you read through the tea leaves of all of this, how do you think the Fed is sort of looking at all this uncertainty as it weighs the next two interest rate decisions?
Yeah, I think they're going to cut. Particularly in the context of no data. If the government remains shut down, they're just not going to have any data. And I think they're going to err on the side of focusing on growth that in fact, the risks to the economy, as I just articulated, are to the downside here. Recession risks are awfully high, and that they will continue to push rates lower, in part because that's, I think, appropriate in terms of this balance between their focus on growth and inflation. In part because of, I think they're nervous about their own independence. And if they don't cut and the economy does go into recession, they will get blamed, and that will really impair their independence even further. So I think they're going to err on the side of cutting rates. So I would be surprised at this point if they did not follow through and continue to cut interest rates.
Yeah, and that is interesting, Mark, because there's a flip side to that argument where if they do cut, maybe they are catering to this administration.
Well, yeah. I think that's entering into the decision-making process. The administration is making it quite clear they want lower interest rates, and the Federal Reserve is, it's a political animal at the end of the day, and it wants to preserve its independence, so it's going to do what's necessary to do that. And I think that, all else being equal, argues for continued lower interest rates.
Yeah, and we have seen that weakness in the labor market as well, which Jerome Powell has consistently said.
Yep.
Mark Zandi, always great to talk to you. Thank you so much. Appreciate it.
Thanks, Ali. Take care.
We've seen obviously this back and forth on AI trade. Is it a bubble? Is it not a bubble? What does it mean for the overall market? Where do you come out on all of this?
I am a little bit worried that it's being overbuilt. What I'm kind of going after now is, okay, if it is working, we should see some secondary effects. We should see that. And I keep coming back to the problem that we probably don't have enough electricity. So I want to invest right now in the things that are going to be needed by the data centers, needed by the AI. So, a lot of what Trump, I think, is doing in the administration, we've been calling it production for security. Those are the trades I want to own. I want to own small caps. I want to own mining stocks. I want to own refiners. I want to own logistics companies, because I think that is the beneficiary of all this.
I want to pick up on one of those things you were saying, and that's small caps, which is an interesting theme. We see the Russell 2000 now matching the other major averages when they hit records. At the same time, there's also rising concern about a bubble in some small caps, particularly ones that don't make any money. So when you say small caps, like how do you screen in small caps
so
right now?
I would say right now what we're looking predominantly is things that we think the administration might care in, because that seems to be the impetus for some of these stocks to take off. So we're looking at the rare earths and critical minerals, and I think they have to be domestic, maybe Canadian. I don't think you want to own a lot of foreign based small caps or anything that has their rights foreign. I think you want to look at the production and refining. You're starting to look, I think, at biotech. Where could this administration decide they want to put some money in to jumpstart things? Because I think you get three things with the administration. One, you get their money. Two, potential government spending. Three, they've been kind of encouraging lending to those companies, so you get growth from that. And I think you kind of get this almost need to do business with these companies. So I think there's a lot of opportunities there. We have rate cuts coming, so I think that's going to benefit small caps as well. And so that's why I'm not sure what to do with the Mag 7. Maybe they go higher, maybe not. I think there's much more value and promise right now in these kind of smaller caps and in these various industries. I love nuclear, and weirdly, I'm sad to say it, I'm scared to say it, maybe I like solar.
Why are you scared to say that you like solar?
Well, because everyone hates solar, and solar is clearly has not been treated favorably by the president. I think whenever the president talks about energy, he's very focused on clean coal. I think they're moving towards nuclear. You're seeing, I think, deregulation that will allow the nuclear plants to grow, so that's going to be a huge winner. But I think he's also being advised that, hey, you might hate solar, but it's probably the single best way to get up and running in the next 3 to 5 years. If we want to put some baseline on as we build out coal, nuclear, solar is going to win, and Trump is willing to pivot. He might hate it today, but I think he can come up with reasons, and he does listen to his advisors.
Well, and if that's where people want to put their money in terms of invest, if people need that energy and they're putting money there, it'll follow that to some extent. On the nuclear front, I mean, some of those plays are also very speculative. Sure, we have the big energy companies that already own nuclear assets, right? But then you have the small modular reactor companies that don't actually make anything yet and won't for the next few years. Do you also, make a bet on those?
So I think you can make a small bet on those. One thing, one of our retired generals, General Waddell, he was poking around on the Department of Energy website. There are 70 nuclear projects, in approvals that have been approved, but only one has the regulatory approval. I think that's going to accelerate, and we're going to see a lot more of those. The U.S. Army just announced that they're actually going to put small nuclear reactors on some of their base. So I think you're going to see growth there. I think I like the need for uranium, but I also do think you're right to, invest in some of the big people, right? I always think the energy companies of the future are often the energy companies of today. They have thousands of PhDs who've been excellent at extracting energy from this planet, and how they do it is shifting, and I think they will embrace and figure out nuclear as well. So I think you want to be kind of across the board in big caps, and what I like about the utilities and even big energy, they're clearly not overbought. In fact, some are underweight, so I don't think you have that bubble risk. If I'm wrong on my thesis, maybe you go down a little bit. If I right on my thesis, you get maybe 20, 30, 40% gains in the big caps, and doubles and triples in your kind of lottery picks, knowing that one or two are probably going to go awful.
And Peter, you mentioned the general, and this is a good opportunity to remind folks who are watching, if they're not familiar with Academy Securities, you guys cater to that veterans community. You've got members of the military, ex-members of the military who are advisors to the company. And so coming back to something else you mentioned, production for security, or ProSec as you're calling it, as sort of an underlying thesis for a lot of the other things that you're talking about. Explain that a little bit more.
So I think, what they're looking at, and we're saying, what are the kind of pitfalls that we have that we can't make enough of on our own, that we really, really need to? I'm not talking about stocks, who really cares about that necessarily. It's going to be chips, right? We need to make our own chips. We need the rare earths and critical minerals, and not just the rare earths and critical minerals. Those we can buy, I think, in the market. We need to process and refine them. I think you're seeing some of this action occur in steel, where we got involved in U.S. Steel. The government got involved. I think you're going to see them look for champions in other industries. So I think anything that you think about that, hey, if someone turned this off to us and we couldn't get it, how bad off are we? And I think that's kind of the definition of security. So not necessarily military security in the traditional sense, but security for the things that we need to grow and
supply chain security effectively.
And so it's going to be very focused on those things: chips, critical, electricity, right? If we want to win in AI, we need electricity and chips. So that becomes a national security risk. And that's where I think this government's turning. You saw announcements by JP Morgan the other day that they're upping their investment. I think this almost becomes the new ESG, where everyone adopted ESG as kind of a mantra. And I think this will be a shift or an evolution in that. We're like, okay, but we have to take sustainable to mean maybe a tougher definition of sustainable. Like, can I survive without this? If the answer is no, we need to make or produce this or procure this, either ourselves or with our very close allies. And I think this could actually be a very long-running investment theme, because so many of these areas are underinvested, right? A lot of the banks didn't want to invest in some of these areas. Nuclear is very unpopular. So although they've had these big gains, if I'm right, we're maybe only first two batters in a 9-inning game have come to the plate.
Really interesting stuff. Peter, it's great to see you.
Great to see you too.
Thanks for coming in.